What do you think about investing in the 30 years Treasury? If the yield holds steady above 5 or goes up even more, do you think it could be a good idea to invest in it? It'll essentially be a risk-free return and you won't need to worry about any potential decade-long roller coasters in the market just for an extra 3-4 in return from equities stocks. I am wondering what counterarguments are out there against investing in the 30-year Treasury if the yield is high enough? Any insights will be greatly appreciated. Thank you. You will probably beat 90 of the users on this sub as they jump from one investment to another. You do realize that extra 3-4 annual return you're brushing off compounding over 30 years is fucking massive, right? Depending on the size of your account, that could easily be hundreds of thousands of dollars. If you have 30 years, there's no need to stress about the short-term roller coaster you speak of. The risk is 100 worth the reward. Yesterday, the main reason the stock tanked in midday was because the US government had a lot of trouble auctioning the 30 years Treasury and the market spooked. This tells you what investors in general think about 30 years Treasury. A delta of 5-6 over 30 years is very, very significant. I wouldn't, but I'm 22 and I understand inflation. Just for an extra 3-4 in return from equities stocks. Compound that. You can sell the Treasury as well. If the yield drops, the price of the Treasury will go up. For the 30-year, I heard that if the yield drops by 1, the price of the Treasury goes up about 10-20. Some people are hoping for a crash and yields to drop back to normal levels. They will sell the Treasury and make a lot of money. But if the 30-year goes up higher and stays higher for longer, then you're stuck in it. Terrible idea. The 5 return on the 30-year Treasury is based on a fixed principle. Let's assume you invest $1 million. You will receive $50,000 in coupons per year and have your $1 million returned at the end of 30 years. Let's also assume inflation is simply 2.5 per year, which is the long-term average inflation rate. At year 30, your coupon will be worth $23,837 in future purchasing power. Your principal will be worth $476,743. Moral of the story: long-term investments require compounding returns. There's no such thing as 30-year risk-free return. Pretty much everything can change in that time frame. That's why the yield compensates the risk. Keep in mind that the real return, i.e., minus inflation, is currently closer to 1.5 and no one knows how that's going to evolve over time. Your purchasing power is still at risk with a long-term bond unless it's TIPS style, which are nowhere near 5. You really want to lock in 5 for 30 years? I'd want something at least on par with the SP historical return to make a 30-year commitment. If rates go that high, you'll be kicking your 5-30-year in the face. You'll get cooked by inflation. It's not a risk-free return. It is a return-free risk. The nominal yield doesn't matter. All that matters is the real interest rate after inflation. If you get more dollars, it doesn't matter if they lose purchasing power at a faster rate. You outlined the benefits. The risks that I know of are prolonged inflation, potential for losing a lot of money if you need to sell these bonds before maturity, and the possibility that interest rates go up even higher after you buy the bond. How about buy the 1-year bonds for next few years? Why 30 years bonds? 30 years Treasuries outperform stocks historically in rate cuts. I'm waiting a bit as I want 6-7, or I'll just stick to munis for the tax advantage. California here, so that's big. Treasuries longer than 5 years are extremely risky. Say inflation goes up to 13, interest rates to 15. Then you lose most of your money. Would you have believed 2-3 years ago we have 8-12 inflation? The EU is in a recession. What will the EU do? Keep the balance sheet high. Print money. It's not risk-free. I put a few thousands less than one of my retirement portfolio in this past auction for a 4.75 bond. I don't have much experience and knowledge buying long-term bonds, only short-term T-bills, so I wanted to get my feet wet and see what happens when the interest rate goes down or up. Basically, I wanted to get my feet wet in the long-term bond market without adversely affecting my portfolio. I wouldn't buy treasury bonds until the Fed does QE again. The supply-demand dynamic is such that the supply side is swamping the few remaining buyers left. Fed needs to be a buyer again for this asset class to be safe. Why are you assuming it's risk-free? Treasuries are quite risky on a 30-year time horizon, considering that the national debt is exponentially increasing and that the government has no plans to pay it off. The debt ceiling is always being raised earlier and earlier in the year, and shale oil, the energy source that pulled the USA out of the last recession, is set to run out within a decade. There's a serious risk that the government defaults on the debt in the next 30 years. Especially when you factor in the political situation and the fact that energy is only set to become more expensive. Long-dated treasuries are not really something that individual investors should own most of the time. The interest rate risk is just too high. Long-dated treasuries are best owned by pension funds, charitable organizations, etc. in order to meet long-term funding obligations on a guaranteed basis. If we ever saw the 30-year go above 10 again, maybe I would sing a different tune. But I don't think that will happen. A 10-year note is probably the longest most individual investors should go. And probably even shorter, under 5. I am an income investor. To me, getting a guaranteed 5 on some portion of my wealth, which I can flip for a big profit if yields fall, is attractive. 100 stocks is a poor man's attitude. I'm interested, but not at these rates. I'd hold a 30-year at 9-10 and would buy a lot of it. The only reason to buy a treasury is to trade it. The principal will be pennies in 30 years due to inflation. Invest a small portion of your portfolio in 10, 20, 30. It's a good way to diversify, but it's not risk-free. If inflation spikes, you may underperform equities significantly. Interest rate risk is pretty high right now, and eventually that yield curve will revert from inverted. I see them depreciating. Stick to short term for now if you want fixed income. Unless this is one of the very special times like the early 1980s again, I wouldn't bet on it. Where 30-year treasury rates are 10. You are probably better off with other options such as SP 500. Problem is, this will be spitting off interest payments that you can't reinvest back into the bond. If you take the interest and roll it into more long-term bonds, after some period of years the interest rate on those new bonds will eventually be less than your original, and then you are really behind the 8 ball. I see the 30-year treasury as more of a duration play when rates come back down. I bought some recently at yields greater than 5. It's a slam dunk place to put some capital to balance out a portfolio. If the market crashes, I'll have some funds to reallocate to the SP. For me, it makes sense. I am 63 and have enough invested that around 5 puts me in a comfortable lifestyle under almost all scenarios for the rest of my life. That is my number one goal. Building wealth is secondary. If you are under 40, I would recommend against putting more than a small percentage of your investments in bonds of any type.